Hello, everybody. How are you all doing today? Good, good. So, as Tim said, my name is Crystal Thomas, and I'm here with my colleague, Dante Andrade, and Jay Ritter also is here with us, part of our team with Brad Sumrok. So, just a show of hands, how many in here are familiar or have heard of Brad Sumrok's Apartment Investing Group? Okay, awesome. Quite a few people, and we also have a lot of people who haven't. So hopefully today we will give you a really good snapshot of what we do and also help shed some insight and light on 2019 and kind of what to look for, what type of economic drivers are out there that are pointing to hopefully positive market for apartment investing. So I'm going to go ahead and just jump right in. Let's see here. Can everybody hear me okay? Okay. All right. Okay, so as you can see here, our title for our presentation, Apartment Investing in 2019, will a good time to continue. So many people have been investing in apartments and really just real estate in general, especially if you started after 2007, 2008. Pretty much have seen just awesome returns from investing because the economy and the market has been so good. So some people who haven't been investing since before the market turned, think that everything is just easy and rosy and haven't really had any challenges or seen any signs or what to look out for, for ways to change the way you are underwriting deals to ensure that you are achieving those returns that you're looking for. So today we have about an hour, and we're going to do our best to really stick to that time frame. I know after this we're going to break for lunch on some barbecue, so we will do our best to really stick to our time frame here. But this is what we're going to talk about today. A recap of 2018, just a brief recap of some of the key drivers that really influence positive conditions for investing in apartments. We're going to talk about our recipe for earning double-digit returns, what makes a good market, forecast of 2019, and then Brad Sumrok, who, so those of you who do not know who Brad is a teacher, a coach, a mentor. He teaches people how to invest in apartments, and he's been investing in apartments himself for almost 17 years. And I started out as a student. I'm still one of his students. I enrolled in a training program that he provides, January 2014, so 5 years. And since then, my husband David and I, we have been partial owners in about 1,500 doors. That's 9 apartment communities. And, it's a blend of how we're investing. That's something that we'll touch on a little bit. There's different ways that you can invest in these apartment communities or apartment businesses. So we've been a passive investor, we've been a lead syndicator, and we're just going to touch on a few of these things, today and give you a little more insight to it. So we're going to talk about the top 15 markets that Brad sees meet his criteria to invest in. And then we'll also just share with you, how you get started. That's a big question. A lot of people here, we're here for topics of real estate investing. So, how do you get started in investing in real estate, specifically in these multifamily properties? So let's go ahead and dive right in. So just a quick snapshot. Let me just see what it looks like because it's a little blurry on my screen still. Okay, so 2008. This is a quick little recap of some important levers that really affect the market conditions for investing in apartments. So you can see here, I'm not going to read everything, but occupancy is up from 2017. That's a huge driver for the performance of your apartment business. So I say it's a business because kind of switching your mindset of viewing like a single family purchase as an investment property. if you are purchasing apartment buildings, you know, you're buying a business basically. So you control the value of your business based upon how much income it generates. So there's many different things you can do to increase the income of your property. Occupancy is a huge one. So year over year from 2017 to 2018, occupancy's up, rents are up, and new construction is down. So these are all very helpful items that really help your when you are analyzing your multifamily properties and underwriting them, that really point towards it being a smart purchase. So Brad's program, we have students that are just totally crushing it, and through the help of Brad's training. So just in 2018, our students bought 52 apartment communities. That's almost 7,300 doors. And this number is just, I'm really proud of this number. Every time I see this number, it just blows my mind. Over $500 million in purchase volume. And in private equity raised to buy these properties, $165 million. So if you think about, you know, the typical mindset of a non-real estate investor is, you know, okay, I'm going to invest in the stock market. I'm going to make sure that I'm, you know, meeting my company match on my 401k. I'm going to do, you know, mutual funds or something, whatever, you know, go to Wells Fargo and meet with any, you know, banking representative and just do whatever they tell you. So if you look at this chunk of money, this is money that we took out of the stock market, that we took out of investing in these things. And this is investing in something that is actually helping people's lives. So the target properties that we look for are in that, you know, C-class, 14-class neighborhood. And we go into it with the mindset of improving the quality of life for these people. So helping improve the property that they're living in, you know, making immediate aesthetic changes, fresh paint, new flooring, you know, new light fixtures, new landscaping, like bringing the property, kind of reviving it and bringing it back to life and making it a safer, more comfortable place for people to live in. Wow, we are helping the people that have entrusted us to invest their money with us. You know, the goal is to double your money in you know, 3 to 5 years. Let's see here, and then our stats for 2018. These properties were purchased in over 17 different markets in the United States. So, you know, a lot of people ask me, well, what if I don't live in Dallas, Fort Worth? Well, you know, everybody's buying deals in Dallas, Fort Worth, and you know, there aren't deals like that in other markets. Well, we bought properties all over the country, 17 different markets. Some of them in Dallas, Fort Worth, some of them in other cities like Little Rock, Arkansas, Jacksonville, Florida, Phoenix, Arizona. So there are deals out there other than just in the Dallas-Fort Worth area. This stat here, so this is just a little bit more of a deeper breakdown of our results. So it's an average, each deal is an average of about 140 doors. So I've lost all that talk really loud. And an average of about $3 million in private equity raised per property. So how do we do this? Well, the place that I started and that Donkey started and that Jay has started is choosing someone to teach us and to train us, and choosing someone that has proven results and that has done what we want to do. And so that's why we chose Brad as our mentor and to help us. And he's helped hundreds and hundreds of other people. I'm just a regular person. I'm here on my own to come here today. You know, I'm here because it works, and it has helped change mine and my husband's lives for the better. And you know, 10 years ago, we started investing in multifamily, or not in multifamily, but we started investing in real estate, and it was kind of a slow process for us. We were focusing on single family, and we were focusing on strictly buying and holding. And that took us a long time to just get our first property with that. And, they cash flow decently. We have 3 single-family homes. And we realized, we personally, for our goals and for our family, we wanted to do something to accelerate our goals and to add to our current, single-family investing strategy. So, it's not that you're choosing one over the other. It's what are ways that you can impact, and accelerate your investing goals. So, one of the things that Brad teaches, and this is, 16 plus years of experience that he has, and so just keep in mind, he started doing this before the 2008, 2009, economic dip, and he survived. He didn't lose any money. His property thrived, and so he's weathered those storms, and he knows, what to really look for to ensure that you are underwriting your deals to weather any sort of market correction. So, our recipe for double-digit returns is that, like I said, you really want to focus on your education and hiring somebody who has done or choosing somebody to teach you how to do what you want to do. So I already mentioned this. Our target markets that we look for are properties that are in a CBD class neighborhoods, so that's your working class, blue collar. Typically, it's really what helps. That is part of the whole, area that you're looking for underwriting to make sure that those deals are working for you and that you are purchasing properties that you can make some immediate impact and you control the value of the property. So one of the biggest differences between single family and multifamily is that typically for single family properties, the market determines the value of the property, the comp surrounding it. For multifamily properties, it's how much income is that property generating, which you can control by, increasing rent a little bit, adding more value to the property, etc. Selecting the right market, so we'll talk about this a little bit more in our presentation. And then leverage. So with syndication, which that term some of you are probably familiar with, some of you may not be. But what that means is that you are raising capital from other investors to purchase this property. And so you're able to go after these larger deals because you have people that you can leverage. You can leverage other people's time and money and talent to help you. And then this looking for properties that are 60 doors or higher. The reason for that's typically our target. We do have students that buy properties that are under 60 doors. For me personally, I want to buy a property that is at least 60 doors or higher because it supports an ability to have full-time property management on site, to have maintenance on site. Usually with properties that are under 60 doors, it's not generating enough income to support the payroll basically of full-time property management. So the property management is going to be on your shoulders. And this, to be a true business owner, Robert Kiyosaki, I'm sure many of you are familiar with Robert Kiyosaki, he talks about the cash flow quadrant. And, you want to be on the right side of the quadrant. If you're a true business owner, then you are not going to be the person that's answering the phone, handling a maintenance request, dealing with evictions or anything like that. So being able to be completely hands-off, or not completely, but being hands-off of the operation of the property, these 60 doors and higher generate usually enough income to support the expense of those services. So what makes a good market to buy these multifamily properties in? So you want to look for an area that's landlord and business friendly. So for instance, a friend of ours who's a student in our program as well, he and his wife and 2 children, they are working on moving from where they currently live, which is in New York, down here to Dallas. And he's trying to get all of his properties right now up in New York off his plate. He's trying to sell them. So he has a nice apartment in Brooklyn, and he just got this frantic call from his contractor. There are squatters. Well, they got there just in time because in New York, if a squatter is living in a property, I think it's for like 30 days or longer, then it can take up to a year to legally get them out. So that is an example of a non-landlord and business-friendly market. That is not an area that I would recommend purchasing a multifamily property in, because any sort of things you're going to have to do, and unfortunately, yes, you do have to occasionally deal with evictions when you're dealing with tenants. And so you want to purchase in areas that are landlord and business friendly. Above average cap rate. So we're going to dive into more cap rates here a little bit further into our presentation. Job growth. So obviously, if the market is showing a retraction in job growth and population growth, then that is a good sign that is not as strong, that economy is moving in the opposite direction that you want to move in, of where you are looking to purchase these multifamily properties. Obviously, here in Dallas-Fort Worth, our job growth and population growth is on a very consistent, upswing. Let's see here. Talk about population growth, affordability gap. We actually have a fancy little graph on this that we'll talk about later. I don't want to spill Dante's thunder, but he's going to talk about in more detail the economic drivers. And then close to home, this is a bonus. It's not a must, but it is helpful if you have some familiarity. Otherwise, Brad teaches having partnerships that make sense. So then maybe you partner with somebody who could be your boots on the ground there. But familiarity is with the market is a bonus. It's a plus. It's not a requirement, but it certainly helps. So living here, if you wanted to buy properties here, I mean, that's great because it's in your own backyard. You can, on a dime, you can run over there and go see it if you need to. But it's not an absolute requirement. Higher returns and lower risk. So that's selecting the right market will typically help you have lower risk in your property. For instance, you're not going to have to spend a year getting someone out of your property. So I wanted just to show you a little bit about Dante and myself. So this picture right up there, that's Dante and Brad at his property, Avalon in Arlington. He purchased this property in August of 2016 for $2.82 million. And in about 3 weeks, we're closing, and I say we because I'm actually a passive investor in this deal in that property. In about 3 weeks, it's going to close for a sale price of $5.25. So you do the math, pretty nice profit. And the beauty of this is that he's selling the property with meat on the bone, as you say. So he's teeing it up for the next buyer to be able to go in and make the same type of things that he did. There's still units, for instance, that need to be upgraded. So he's leaving some meat on the bone for the next buyer to be able to make some improvements and changes and increase the rent a little bit more, increase the value of the property. So this is just one example of hundreds and hundreds of properties. This picture down here, this is LaDonna's apartment, and this is actually in Wichita Falls, Texas. And this is me and my husband, and this is Larry Troy. Larry's another one of Brad's students, and my husband and I partnered with him to purchase this property in Wichita Falls, Texas. It's 124 doors, and we purchased it January last year, so we've owned it for a year now. And we bought it for $5.355 million. So we raised just under $2 million to purchase the property. And in our first year of ownership, we actually were able to send out distributions to our investors a month earlier than we projected. And our last distribution we did was right before Christmas. And it was such an awesome experience because our passive investors, I was getting text messages from different people that holding their check and saying thanks for the nice Christmas gift. And I've even had some of our investors tell us, like, hey, this is like the biggest check that I've gotten as a passive investor. So it's a really feel-good business too, because not only are you impacting the lives of the communities of the people that are living in the property, but you're also impacting the lives of the people that have chosen to trust you to invest their money with you. And, I mean, really and truly, a lot of the reason why people get into investing in real estate is because there's opportunity to build wealth and to build wealth quickly. We all have our why. That's why we want to build wealth. For me and my husband, our family is our big why, and we also wanted to serve and give back. We've had many people help us in our lives and help us get where we are, and we want an opportunity to be able to have the means to serve and give back. So I put a couple of pictures of our twins. We have twin boys. My husband David and I have twin boys. This is Christian and William, and they just turned 2, and so I just wanted to put their picture up there as well to, kind of show you that's part of our why. And also, I work for Brad. I do help run the education company, and it's a very rapidly growing business. And I mean, I put in anywhere from 40 to 70 hours a week for him. I have twin boys. I have a husband of almost 7 years. And, I managed to find the time to invest in apartments, and it's not my full-time job. It is something that you can do while you're working your full-time job too. So, let's see, with that being said, I'm going to turn it over to Dante. And so Dante is our Director of Acquisition for Brad's company. And he has a very impressive past few years here of success. He was a piano teacher, and he actually was able to retire from that by investing in apartments. And now, let's see, what is it, 500 million this year? Over the past 3 years, he has helped in transactions of over 500 million of purchase volume. And then he's a syndicator and investor himself. So he's going to touch on a lot of the economic drivers that are projecting forecast for multifamily investing outlook for 2019. And I'm going to turn it over to him now. So.
Thank you, Celia, and good morning, everybody. Excited to be here with you today, and I've heard we have a couple hundred people online watching live, so excited to be sharing this data with you. Like Crystal said, I'm going to dive into some economic data and the reasons why we're still buying apartments and we're still going to continue buying. If you have questions, we're skipping some of the more basics. If you haven't spent a lot of time looking at apartments and understanding why we invest and how we do this, we'll be around. You're welcome to ask some questions afterwards, but I'll be talking about some of the economic drivers. And it's not going to be too deep, as Crystal mentioned. My background is actually being a full-time musician. And I was fascinated by, reading different books and how to achieve wealth. And then I found Brad back in 2013 and joined his program as a student, and I was able from there to learn a lot, not only from him, but throughout the entire ecosystem that he's put together. And over the past 4 years, I've been able to invest in about 1,200 doors, and I've syndicated 3 deals. The one that you saw, Avalon Apartments, is the first one that I did. And we're going to talk about the big price difference, right? If you're buying a house and you're selling it 2.5 years later for that much more, what drove that? Was the rehab that you did? Was it the market appreciation? So, apartments, there are specific things that we can do to raise the value of the property, and you have more control of it. You don't depend as much on the market. You actually are in control of that process. So the data that I'll be presenting is, I didn't put it together. It came from Brocadia, Marcus and Louis Chaps. Those are big national multifamily brokers, and also from CoStar, who does research all over the country on all kinds of commercial real estate and also from CBRE, which I'm sure you're all familiar with. We saw this slide about 2018 at the beginning of Crystal's presentation, and now we have here the projections for 2019. So earlier this morning, Kane talked about that he was trying not to be negative, but then he went on to deliver a bunch of negative data. So I'm actually going to be positive. We're excited about what 2019 holds for multifamily investors. And this is one of the few indicators that we are always watching, and this is national average, right? So we have to break this down into specific local markets and also specific class of property. But in multifamily, national average, we'll see occupancy going to drop only 30 basis points. So we had about 95.5 occupancy average for 2018. 2019, we're expecting 95.1, which is still a very, very high number of occupancy. These properties are full, and we experience that day in and day out working, with everybody that's in Brad's program and on my own properties. We have employment change, we have employment growth. We have, economic boom happening in the country and jobs growing. I mean, just a couple of quarters ago, the Department of Labor was reporting that the unemployment was so low that we were at a point that everybody was considered fully employed. We have effective rent growth of 3% year over year. Even though rents have consistently risen since 2010, 2011, they're forecasting average 3% growth, which is a very, very sizable number for 2019. We had 2.8 growth in 2018. So we actually have high expectation of higher rents in 2019 than we did in 2018. And another big factor for multifamily is construction. There is a drop of 5.6% year over year construction. If you had a chance to drive around uptown and preschool and the whole corridor here on 75 and even around this area, Valleyview Mall, came down. There's multifamily mixed use coming up, and then you have a lot of high rise that have been built. There was a lot of construction happening in 2017. It dropped on 2018, and we're going to have another sizable drop moving forward of 5.6% projected drop in new construction for 2019. So, we've always said in Texas, looking at the real estate cycle, that we always build too much, and we always overbuild, and that's why, we have a dip. And we're seeing construction changing. That number is going down. Maybe we have learned a lesson in Texas that we're not going to have overbuild this time around. That's what we are expecting. So combining all that together and this slide here is that we're not going to have, a recession in 2019. We had 2017, you can see the GDP projected at 2.5, we reached 2.3. 2018 projected 3.1. We're still going to have a very, very decent growth on the GDP of 2.3 that's projected for 2019, which is the same number that we had in 2017. So we do not see a major change on these, very relevant economic factors. Employment growth. So we're not growing at the speed that we did in 2014, 15, 16, but we're still having, 1.2, 1.4 projected for 2019. You can see it's slightly lower than what we experienced in 2018, but we still have growth on employment overall. Now we have here, we're looking at employment growth, and that's where I mentioned earlier that this is, when you look at a national average, you cannot use that data and go out and invest and apply to investment properties. You have to narrow down to a specific market. And then even when you're looking at our MSA, like DFW, you still have to narrow down to a specific area. So we break down, specific areas of the Metroplex. This is kind of looking at a bigger picture of all MSAs and markets. And we have employment growth, and leading the pack here is Houston, which, is in Texas. And we have, in one of the drivers, we had Harvey that hit last year, or a couple years ago, and then we have a lot of construction development. We have oil that's stabilized. Somehow it's fluctuating within a window that the operators have managed to operate within that, the window that the price is moving. And we have this tremendous growth. We have a lot of corporations moving to Houston, just like we have been moving to DFW. And we have some of these here. So we got New York, no job growth. We have the financial market that are leading that. DFW, as we all know by living here, Phoenix, South Florida, LA, DC, and it goes on. And then we have 4 of them that are circled. Anyone would guess to tell me why do I have those 4 circles in this slide? Investor friendly, yes. And we're gonna, Crystal Lee mentioned how we choose the markets that are investor friendly, that we don't have to fight in court for over a year to remove a squatter from the property. Right in Texas, you can just file in the, well, there is no squatter law. We call the police and they, put up the guns and they leave. But even if it was a renter, we would have to, within 21, 28 days, as you know, you have that person evicted. Not the case on the other one. So we focus on these markets. They are business friendly, they are landlord friendly, and are having all the economic sectors to back it up. So that's one of them. We're always looking at the employment growth. If people are not employed, if employment is not growing, they're not going to be able to pay rent. They're not going to be moving to that area. We're not going to be able to keep their apartment full. So, and here's a chart showing the occupancy and the effective rent. So as you can see, the effective rent has been steadily growing from 2010 all the way to 2019. 2018, that number is our estimate. 2019 is our projection. And you can see the growth of the rent year after year after year. And then you have occupancy growing throughout those years. And we have a small dip on the occupancy for 2019. Like I mentioned earlier, 30 basis points is the national average. But it's still, if you're looking at, going back 30 years, this is still a very high number to keep the properties full at 95%. Use effective rent growth for specific metros. So Las Vegas leading the pack, Orlando, Phoenix, and you can see all the other markets. Again, we have circled the ones that we like to invest in, the ones that are investor friendly, that make sense to do business in. There are several markets there on that list. And why is occupancy high, even though we've built a lot of properties, even in DFW? Like I mentioned earlier, we've built a lot of multifamily. We've had, expansion. As you can see, this chart is a very nice chart going back to 93. That line is the really important one to watch. That's new household growth, so household formation. And you can see that line, it was above in the blue chart with the orange, that's total house construction of houses. So it makes a single family on the blue, and then the orange is multifamily. So as you can see, there were more households being formed in the 90s than we were providing housing for that, which drives occupancy. And then we had a dip around early 2000, 2001, and then in 2004, 5, 6, we have oversupply. And that's when we started to have everybody, that put a name on a piece of paper be able to get a mortgage, because there were so many houses and there was so much money available. And that's probably, that chart is showing, what started to cause, the problem that we had in 2007, 2008. And we have that drop again to the beginning of construction. But as you can see from 2010, look at that line, just spikes. And then you have a lot of household growth. And construction is not keeping up. So throughout all those years, 11, 12, 13, 14, 15, there is more households being formed than we're actually providing housing for. And then we see the same happening again with 17. It was about, almost break even. 2018, 19, we have that number of household growth taking off. And we have a total of undersupply of 2 million houses, multifamily included. So from 2008 to 2019, that's a total of 2 million houses that we are undersupplied based on the number of population growth and household growth. So that's important chart to watch. Looking at that forecast, looking at what happened in 2018 with this estimate, looking at what happened in 2019, I look at this and I get excited. Being a real estate investor and investing in apartments. And here's another one that we're watching closely to help us decide where to invest. The affordability gap. if someone can buy a house for the same price that they're renting, most likely, if the mortgage and the property taxes and insurance are at the same level, most likely they will buy the house instead of renting. But we saw a big wide gap back in 2005, 2006. That came down 2011, 12, and now we have the line increasing again. And we're looking at $339. This is on the difference between a house payment and a rent payment for the same size of house. So if you're looking at two bedrooms, looking maybe at a 3-bedroom apartment or a 2-bedroom apartment, this is the amount more that you have to pay if you own the house. And that's driven by market appreciation and overall on the cost of housing. As you know, if you own a house in Texas over the past 5 years, on paper you've made a lot of money, right? I mean, what you bought for $300,000 in 2013, now it's worth $400, $450 without you actually doing any repairs to it, and you can see that number by your property taxes going up. So we have property taxes going up all across the board. We also have interest rates now starting to move up, which will make the house more expensive to buy. Back in 2012, 13, you could buy a house at mid-3s, high 3% interest on a 30-year mortgage. Now you're looking at least a full point above that number. So that is making looking at how much more you have to spend to own a house, making it easier for people to just say, no, I'll just rent for a couple more years. And, of course, with rent, you come with the flexibility, and we have a lot of new places being built. And here's, looking at that chart, transitioning to the vacancy trends and by market type. So we consider the primary market, like if you're looking at Dallas-Fort Worth, anything that's within DFW, so we're talking Arlington-Fort Worth, Dallas, Garland, Richardson, this is all a primary market. If you go outside, Priscilla was just mentioning Wichita Falls, that's a secondary market. So somewhere that's, within an hour, 2 hours of the Metroplex. And then you have the tertiary markets, which are beyond that. So, it's usually smaller cities. They are not too far from Metroplex, but also not right next to it where people can commute to the Metroplex to work. And as you can see, vacancy trend on the tertiary markets, they're all moving lower comparing to back to 2010. But it doesn't matter where you are, those trends are moving. And of course, we have the primary markets with the lower vacancy, even the job growth and the amount of population, but very, very small difference between those markets. And we do have a lot of people in our group looking at secondary markets. We'll be able to buy a lot of property in Lake, Wichita Falls, Abilene, and within Texas, and also some other secondary markets in other states. And this is a very interesting chart. We have the difference of properties vacancy by class. So the buildings that I've been talking about, that we built all the new high-rises, around uptown and Frisco area and Addison. So this is all A class, right? There is no construction. We have a deficit of affordable housing. There is no affordable housing being built in the Metroplex. Everything that's being built is Class A or Class AA, the very high end of the rental pool. And as you can see, that line is the one that's dropping. So the vacancy, Class A is the one that's going to be, most effective because it's the one that we have most supply of. But if you're looking at Class C, and that's what we focus when investing, Class C and Class B, you can see those numbers. But that's the blue line, the red line being favorable, given the demand on those properties. There are not enough affordable properties for people to live in. The rents that are coming out of these new properties are like way above, the average income of someone that would be renting. We touched base on the interest rate. So the Fed raised, interest rates twice over, the past 6 months. And then, but whenever we're getting a loan, we are not attached to the Fed rate. We're actually always looking at the 10-year Treasury. Pretty much all the multifamily loans are based on that. And as we saw the Fed raise, the 10-year Treasury was about at 3.25, and we had the rate drop to about 2 3/4. So we had a small spike towards the end of last year, on the 10-year treasury, the increase in the rates on multifamily, that number has come down. And right now, it's, around 2.74, and no one can exactly forecast what that number is going to be. But if the Fed raises rates again, that rate is probably around the same number, maybe even move somewhat lower. The sellers that had the expectation, if the rate moves higher, we may end up seeing some of the sellers expecting a higher price and buyers a little lower. So, we're going to have some settling right in the middle. And we've seen that happening through November, December, the profits that we closed during that time. We're still able to get 75% leverage on these properties. In occupancy, around less than 5%. And here's another reason we love investing in apartments. It doesn't matter which side of the aisle you stand as far as politics go. We all agree that our president loves real estate. Right? That's how he made his fortune. And then what are the odds that he is pushing some tax changes that are going to benefit real estate investors? I'm not surprised by that. Anybody? No? Okay, so bonus depreciation, there were some changes acted by the Tax and Jobs Saving Act of 2018 that created very beneficial changes for real estate investors, especially multifamily investors. And Brad is very open about his income and his taxes. He likes to show, that he's not only doing the talk, but he's actually doing the work. So he paid taxes were $935,000. That's the amount of the check that he wrote to the IRS, projected down to zero in 2019. I mean, that is a huge, huge change. How did he accomplish that? Taking advantage of the new tax laws and buying apartments. He bought a few properties in 2018 and did a bonus depreciation, which I'll just briefly touch on it, but we hired an engineer, a company that comes and does a study of the property. Instead of depreciating items that usually are depreciated over 25, 27 and a half years, we speed up. The IRS allows for different things in the property to be depreciated over 5 to 7 years, and that is full depreciation, meaning some items are going to depreciate over 5 years, and then you're not going to have to recapture any of it at the sale, meaning that you can take all that on year one. So I'm taking advantage of this. Everybody in the group is. I'm calculating about $175,000 savings for myself in taxes for 2018. What I'm going to pay in 2019. So really excited about those changes. I hope they stay in for a very long time. The Jobs and Tax Job Saving Act of 2018, that's going to last until 2027. And I hope it will continue on that. So we got several years to take advantage of that. And at the same time, we saw some of the incentives for homeowners decrease. The amount of money that you could expense on your mortgage deduction, it was reduced, from it was $1 million, came down to $750,000 of the value that you could write off. And there are some other changes that's making more, attractive actually to put your money as an investor than actually on a down payment on a house. So here's the CBRE total outlook, and there's a lot of data there. You're welcome to take a picture of that slide on how things are looking for 2019. We do know and agree that we are late in the cycle. As you looked at all those charts, you can see from 2010 a growth on everything moving forward. But I have, when I bought Avalon in 2016, I had, some of people that I know say, oh, no, we're late in the cycle. You're crazy to be buying at this time. I bought Avalon for $2.8 million. We put in a lot of work. We raised the income of the property from $35,000 a month to about $56,000 a month. That generated an increase on the price. That's what a lot of us created by. And now I'm selling for about double the price that I paid for. So someone that was looking at that in 2016 that did not have, now is a good time to look at the economic indicators. They'll probably say, oh, I'm not going to buy anything because I bought in 2012 for $10,000 or now I'm not going to pay $37. Or I pay $37, I'm selling for $71 now, and we are still buying apartments. And what gives us the confidence to do it is some of the data that I just shared with you. It's looking at economic indicators and looking what is ahead, right? People, 2017, we have an average of 350 people a day moving to the Metroplex. Well, everyone that moves here needs services, brings a lot of other people with them, and then of all the jobs being created, that's going to generate a demand for housing. And if we're not building fast enough, they got to go live in apartments, and that's how we've been able to, have really, really low vacancy rates. To look at the third item there, we're talking about, the second item actually, talking about, there is, on top of what we discussed, there's a cyclical change and secular trends of people getting married later, also delayed having children, and we also have a lot of baby boomers that are selling their houses and then wanting to be more walkable areas, wanting to live in an apartment, not to have, with their empty nesters, they want to travel more, they don't want to have to be dealing with, the joys that sometimes come with home ownership. So there is a trend of that happening a lot, and I've seen that happening a lot here in Uptown, which we have full high rises with just a lot of baby boomers moving into them, selling their house, downsizing into apartments instead of a smaller house, which should be the trend. We're going to have a very small, increase in vacancy, as discussed earlier. Rent growth is not going to be, as strong as we had. Some areas of the Metroplex between 2017 and 18, we had 5, 6. Arlington had 7% rent growth between 2017 and 18, but we're still looking at a 3% national average, and it's still looking very strong for the Dallas-Fort Worth market and for any of the markets that you saw circled, which I'm going to summarize here in a second. Looking at workforce housing, it will always be a great investment strategy because that type of housing is just not being built, especially in some of the more pro-business states. New housing, Class A is being built, and then people that are at the working, the blue collar, they are at the workforce level, just not having, they cannot afford those buildings, even we have the high occupancy. So here's what kind of combining everything that I talked about, and you may want to take a picture of this slide. This is what the criteria that Brad and all these students are working right now to purchase. So we're looking at markets that have an average cap rate of at least 5.3%. 5.3% in above. We're looking at the low average per unit. So the national average is looking at $156,000. Well, in dollars, you can buy apartment complexes, C and D class, for 80, 90, between 70 and 90,000 a door. So we are way below. That's what creates those markets that you saw circled. We're looking at the average price of those units. We're looking for above average employment growth, which is the national average of the 1.3, above average rent growth. Affordability gap, that's an important number, $339. So if that number, so you're looking at a city that you can easily buy a house, and it's only going to be, $100 more than rent in that same size of unit, people most likely will buy the house. But if you find that the number is above that average, you've probably seen a good market to be investing in multifamily. We're always looking for landlord and business friendly, and also looking for above average population growth. 1.2 is the national average for forecast, and we're looking to buy places that are above that. DFW is an example of so many people living here, moving here. Phoenix is another example. We have so many people moving to that area. A lot of companies from California moving there, given the proximity to the markets in Florida, Atlanta, and Tennessee, North Carolina, and many others throughout the country. So here's the top 15 markets, and you're welcome to take a picture of that slide of where we are looking to buy and where you should be looking to buy. This is a combination of all the economic indicators and several more that I just touched base on. These markets are leading the pack there is really Charlotte, North Carolina, many other markets. These are all investor, landlord, business friendly. And we bought properties in, I'll say at least half of those markets last year, and we have students in the group that are actively looking to buy in several of these markets.